All right, Assalamu alaikum, everyone. Welcome to today's webinar. I appreciate you all joining on this Saturday. It's a good way, I think, to learn about important concepts through these webinars. That's what we try to do at our firm. We try to focus on education and to help you be prepared to utilize tools and techniques that are available to you in the tax code and various estate planning strategies. So today we are going to be focused on tax strategies that are appropriate or that one should consider at the end of the year. And there's two times when everyone thinks about taxes, that of course at the end of the year, and then when you have to actually pay your taxes. The strategy, like anything in life, the best time to do stuff is before it's due. And so we have about a month left in which we can utilize some strategies, and hopefully today you will find some of these to be beneficial and that you can utilize today. All right, so quick introduction about our firm. Obviously, most of you have worked with us before, but just for those that may be joining us for the first time or that the link was shared with, our firm focuses on estate and tax planning. So in essence, what that is intended to do is to simplify complex estate planning tax strategies to protect your wealth and secure your future. So really, we're looking at what can we utilize within the tax code that will help us to protect what we have today, and also to ensure that when it passes, we avoid as much as possible, unnecessary taxes, burdens, court processes, etc. But today, the focus is going to be more on income tax planning, specifically exploring practical strategies that we can utilize to minimize our taxes from a legal perspective. Of course, there's a lot of things out there, and there's a lot of strategies and a lot of tools and a lot of get-rich-quick, things. Oftentimes, if it sounds too good to be true, it is. But in this realm, it's very important to understand that the idea of preemptive strategic tax planning is completely legal and has been codified by the Supreme Court in countless cases, that when you organize your wealth in a manner that allows you to minimize the taxes that one has to pay the government, that's totally legal. And there is, in fact, no patriotic duty to pay more than you're supposed to. So that's really what we're going to focus on today, is that we want to make sure that we utilize everything we can. The more wealthy a person is, oftentimes they have advanced tax strategies and lawyers and CPAs that are helping them and advising them. And we want to make sure that we are taking advantage of some of those tools and techniques to benefit our families, and also to make a difference in society directly, as opposed to giving the government money and asking them to do it for us. And we know that oftentimes they're doing quite the opposite. By way of disclaimer, of course, I am giving general advice, so don't take this as legal advice, as tax advice. I'm, of course, a lawyer, but not your lawyer. That is to say, until you engage us specifically for a transaction or for a project or for something that you need from us, then in general, this is just advice. And of course, you need to engage us specifically. We'll be happy to do so after this. So we'll be together today, this afternoon, for about an hour. And the idea is, at the end or at any time throughout, you can add questions into the Q&A. And then if you'd like specific advice or you want to utilize some of these tools and techniques, some of them you'll be able to do by yourself, and some of them you'll want to reach out to an advisor, an attorney, a CPA, etc. And if you'd like our help with that, we would be more than happy to assist. So, there's this famous quote that there are two inescapable realities of life, and they are death and taxes. And I think it's really important to think about this. We spend our entire life trying to accumulate wealth and thinking about how can we ensure that whatever we have grows, and that we are protected, and that our families after us are safe, and that we have retirement, and that all of these things. But the two things that are critical, one is death, is inescapable. Obviously within the Muslim tradition, we believe that this life is just a test, and how we acquire our wealth and how we utilize it and how we invest it and how we leave it behind, all of this is part of that test. But the reality is, whether you believe in an afterlife or not, you cannot deny the fact that everyone's going to die and that nobody can take their stuff with them. So that's the two areas that our firm focuses on, is thinking about preparing for death. And then for most people, their largest expense. So their largest expense is actually taxes. So most business owners, if you look at what really is their largest, what cuts the deepest, it's not payroll. Oftentimes it's taxes. And especially for highly compensated employees. And so planning and being strategic about that is something that is very, very important. And that's what we're going to look at today. And the reality is, if you don't plan for taxes, you're going to have less to give at death to your family. So it's really important that one tries to minimize, again, with utilizing all the legal channels that are accessible and available, so that you have more to benefit yourself and your family, and obviously charity in that process. And we're going to focus a lot on the question of charity and what are some strategic methods of giving. So before I do that, I just want to give a couple statistics about charitable giving. Over $500 billion annually go towards charitable giving in the United States. So this is a massive enterprise, philanthropy. And it's really critical to think about, how are these dollars being deployed and what's really happening. So you often hear about these, Silicon Valley founders who are giving billions of dollars to charity. Or you've heard of the Giving Pledge, where some of the world's wealthiest people, especially some of the wealthiest Americans, are pledging to give all their wealth to charity. And I want you to think about that. It's philanthropic. It might be done from an altruistic purpose, but understand where and how are these funds being channeled, what is actually happening, and what are the opportunities for the average person, or person who is doing relatively well but nowhere near the Gates or the Warren Buffetts or the Zuckerbergs of the world. How can they utilize those same techniques to achieve some of those same goals? So I want you to keep that in mind as we go through, because I'm going to share some of those strategies as we proceed through today's program. So it's important to understand a few concepts as we work through this lesson. So, income tax strategy is not the most exciting thing typically, but we're going to try our best to have some education about these concepts, because without them, you're blind. You're just trusting someone to tell you what to do. And so I want you to understand what exactly is happening when we are thinking about income tax strategy. So first, of course, is income. And income can be of different types. And so you want to make sure that you understand that there is, earned income, there's passive income, there's rental income, there's capital gains, there's different types of income. And the type of income is going to matter, whether you're getting a dividend, whether you are receiving a retirement benefit, whether you are earning income. All of these things are going to have a characterization, and they are going to impact the taxes that you have. And so it's important to understand, when we think about gross income and adjusted gross income, it's important to understand what buckets is the money coming from. Where is my wealth coming from? Is it W-2 income? Is it 1099? Meaning, is it pre-tax or post-tax? Is it coming from a retirement account, etc.? So that's the first thing to understand, is that there are various types of income. It's not just everything lumped into one, but there are different types of income. Now, there are certain things that are excluded from income. And that's different from a deduction, which is different from a credit, okay? So a lot of times people think, if I donate $100 to charity, then that means I'm going to save $100 from my taxes. And that's not actually the way it works. So an exclusion from income is something that perhaps you are getting, but that is not going to count towards your income, towards your gross income. So to give you an example, you might have for those of you that are, and we'll talk about this more towards the end, but for those of you that are taking required minimum distributions, so if you're above the age at which you must now take distributions from your retirement accounts. So it used to be 70 and a half, and then it went up to 72, and it will go up shortly in a few years to 75. But basically, if you are one of those people that are required by the government to take those distributions, those are called RMDs. Those count as income. And by counting as income, now you have to pay income tax, and you also will be disqualified by for certain things. So there are certain phase outs in the tax code based upon how much income you have. So, I mean, to give you an example, I was looking at, EV vehicles, electric vehicles. So some of those electric vehicles have phase outs on the credit, which comes to down below, but there's a limitation on how much income you have. And so if you weren't including gross income, then you might be able to get some of those things. Similarly, the ability to fund Roth IRAs and so many different things within the tax law are based on your total income. So if you can exclude certain income, that would be advantageous as one method. So if, for instance, you had your RMD go directly to charity, so this is called a qualified charitable distribution, it would actually be excluded from your income. That's different than, say, a deduction. A deduction is basically where you have income, but then you're going to, say, donate to charity, and instead of making, say, $200,000, you donate 10% of that, let's say $20,000 to charity. And so you would lower, theoretically, your gross income from 200 to 180. So you would be paying tax on 180,000 instead of 200. That's the idea of a deduction. And deduction comes in different, different variations as well, whether it's a business deduction or it's a personal deduction or it's a charitable deduction. There are various kinds of deductions within the tax code. Contrast that to a credit. So a credit is actually a dollar for dollar tax savings. So instead of saying, I'm going to donate $20,000 and I'm going to lower my taxable income from 200 to 180, what's actually happening is that you are now lowering your tax that you owe the government. And so the most famous of these is the child tax credit, for example. So $2,000 that each child will save you on your actual federal taxes. And there are a number of different state and federal credits, which a person may want to make sure they are taking advantage of. In Arizona, for instance, there is the corporate tax credit that goes towards private schools. There is a private school tax credit. There is a qualified nonprofit credit that you can do. So these are tax credits on your state side. But then on the federal side, there are actual credits that you will save towards your federal taxes as well. And so it's important to understand some of these concepts. Now, at the same time, I want to talk about estate tax concepts because we all know that this has a lot to do with who's in charge. And so we'll talk about the Republican victory and we'll talk about what some impacts of that will be. But it's important to understand that there are three things that are relevant for a person who passes away for their family to be aware of and in advance when you're thinking about leaving wealth behind. So on the first level was income tax, and that's based on your income that you're earning on a yearly basis. Estate tax is a tax that is due on death. So estate and gift tax are taxes that would basically be due on death or that you can have when you gift money away to others during your lifetime. So in 2024, each American who is a citizen will have a $13.6 million exclusion. So that's a lot of money. And you can couple that as a married couple. So you're almost at $28 million between a married couple, that if you give away that much to any individuals besides charities, because charitable giving is unlimited. So if you're giving to a 501c3, it's unlimited. You could give all your wealth and there would be no tax. But we're talking about if you were to give to individuals, either in your lifetime or upon your death, you have $13.6 million. Below that, there is no federal estate tax. Now, if you're in a state that has an estate tax, specifically there's a number of states still on the East Coast that have state estate taxes. Most states, about 40 or so, have eliminated that tax, but there are about 10 or 11, I believe, that still have a state estate tax. So you have to be aware if you are in one of those jurisdictions. But if you are in most of the country, you won't have to worry about a federal estate tax. 13.6 million is kind of like a coupon. You can either use it while you're alive or you can die. And if you leave that much wealth to your heirs, you won't pay any federal tax. Above that, you're going to pay 40% for each dollar above the exemption. So it's a very heavy tax. If it impacts you, you want to make sure that you are certainly doing whatever you can to minimize that tax. Now, what's critical to understand is that this tax is actually this exemption is actually doubled under President Trump's original Tax and Jobs Act cuts. So at the time, it was about $5 million exemption, inflation adjusted. The Congress and presidency at that time, they doubled it. And the exemption is set to expire at the end of next year. Meaning, under current law, that 13.6 million, which would adjust for inflation to 14 next year, is going to drop in half to 7. So let me say that again. At the end of 2025, under current law, January 1st, 2026, the exemption is going to drop to $7 million. Now, I have a lot more clients that have $7 million than have $14 million. And so if the law does in fact change, then this would be really, really important for people to understand. And then we would do a lot of gifting transactions in this coming year, because we would want to make sure that if you utilize the higher exemption, that $14 million exemption, the government will not claw that back from you. So you can use your full coupon, but if the coupon amount drops, then you're stuck with whatever's left of that coupon. Now, this whole calculus has changed because Republicans won both the Senate and the House, as well as the presidency. And so most experts are saying it's highly, highly, highly unlikely that a Republican Congress would allow this exemption to expire or to sunset. And what that means is that the exemption amount would remain high. Now, there's a couple things to understand here, which is that you can never be confident in Congress. So who knows? But safe to assume, nonetheless, that a Republican Congress, at least for the next 2 years, that has essentially an unlimited ability to push through its agenda, is most likely going to change this rule and not allow it to sunset. So it's important to at least pay attention. If you are in that bracket of, say, someone who has more than $7 million, but less than 15, it's really, really going to be important for the next 5-6 months to follow the tax law and make sure that if, in fact, it looks like this is going to sunset, we're going to want to make sure that we are doing gifting transactions to lock in that higher exemption. All right. Now, in addition, there is something called an annual exclusion, which means you can give these annual exclusion gifts to as many people as you want without counting towards your coupon. So $18,000 this year, you can give to as many people as you want as gifts. No tax on the receiver, no tax on the giver. And what this does is this allows you to chip away your wealth and give it to as many people as you want without even informing the IRS. So I highly encourage folks to do this, whether that's to grandchildren, whether that's to other relatives, whether that's to children, but utilize your annual exclusion if you are in fact somebody who this may be impacting, because this is a free amount that you could give away without using any of your exclusion. Finally, the idea of a step up in basis. This is a core function and important concept within the tax law. So under the current tax law, there is something that called a step up in basis that occurs when a person passes away. So as long as assets are considered includable in the gross estate of an individual, that individual will be able to have his or her assets stepped up on death to fair market value. So let's take an example. Let's take someone who was an early investor in Bitcoin. So now Bitcoin, of course, right now is, at its all-time high near 100,000. Let's say you got into Bitcoin early at $1,000. So you bought some Bitcoin at $1,000. Now you're sitting, incredibly comfortably at $100,000. I have clients like this, right? So if they decided to sell the Bitcoin at $100,000, there's going to be $99,000 of capital gains. We're going to think about what are the tools and techniques and what are some strategies that one can utilize to mitigate some of that tax burden. But maybe that's something that a person might be considering. Number two, a person might say, well, I want to gift this to my child. I want to gift this to one of my children. Great, you're allowed to. If you've got less than that exemption amount, it won't cost you anything in terms of taxes, but the child will take, again, not paying any taxes, but the child will receive your original basis, that $1,000 basis, which means that if he or she subsequently decides to sell, they will pay the difference between the fair market value, let's call it $100,000, and the basis, let's call it $1,000, just like you would. So there could, again, be a heavy capital gains tax that would be due on the child when he or she sells, not on receipt. It's not a deemed distribution, but ultimately when he or she decides to sell. Now, the third option is you say, I want my child to inherit this asset. And here's where the tax code basically says, there's a huge windfall, because the tax code says as long as it's part of your gross estate, it's going to receive a step up in basis on death, which means the child will inherit at the fair market value, meaning $100,000. And if he or she decides then to sell, they will pay $0 in taxes. So this is where strategy comes into play. Should you gift, or should you allow the child to inherit? Because there is definitely an advantage to inheritance under the tax code. Now, there might be a good reason for gifting. And in our firm, we highly recommend gifting when it's appropriate. So it's important to understand, you don't make decisions based on tax alone. You don't make decisions based on tax alone, but if there's a good tax reason, then you're going to want to make sure that you are considering all of these things. All right. So 2024 elections, unprecedented times that we live in. And these elections have a fiscal impact on us. So at least for the next few years, as we said, the Republicans have full control. And, usually when there's a pendulum shift, there's going to be one back the other way eventually. But for the next few years, it's highly, highly, highly likely that the Republicans will push their fiscal agenda, which includes things like, and has always been the case, that they would like to keep the exemption as high as possible, in some cases eliminate the estate tax altogether. Now, there's of course been some very outlandish proposals that we've seen. They tend to happen, but who knows at this point? There's certain things like abolish the IRS and this and that. Of course, it's not going to happen, but it's important to at least be aware of what's changing. Republicans in general are in favor of making sure that these taxes have historically been, the exemptions have been high, and also minimizing federal estate taxes as well. But understand that you still have to fund the government. And so where is the money going to come from for the government's obligations if all of the taxes are being cut? So it's impossible that every tax will be cut. It's not possible. So this is where some pundits are saying, look, maybe they will let the estate tax exemption and sunset, and in order to lower the tax brackets for the average person. Because remember, how many people does that estate tax actually impact? So again, this is just one way of saying who knows. And also, when doing estate planning, it's important to be flexible, because you never know when you're going to die, and you never know what the law is going to be at the time you die. And so this is where it becomes challenging for a planner, and this is where a lot of the self-help stuff fails. If you are not accounting for various contingencies and possibilities, it could be the case that you die at a time when the law is unfavorable and your plan is drafted in a way that doesn't acknowledge or doesn't take into consideration what those rules are. But let's think about it from this perspective. if in fact the government and the Republican Congress seeks to lower the average person's taxes, it would be more advantageous for you to get deductions this year, because this year might be a year in which you are paying higher taxes. So if everyone's going to pay lower taxes under a Republican administration, then this might be the year in which you try to do some advanced planning so that you can save more taxes this year, because your taxes would go down anyways next year. So be aware of this as you think about what is possible for me in the next few weeks with respect to how I can allocate and how I can plan. All right. So I like this slide, making sense of tax planning, right? And the tip here in the corner on every one of these slides, I have a little tip, which is that you don't let tax drive all of your decisions. Because most of the time, when you spend $1 for tax planning, you're only saving 33 cents. So almost all of the tools and techniques are about lowering your taxable income. And what that does, of course, is that it saves you, if you're in a high bracket, somewhere between 30 and 40 cents on your dollar. Now, maybe if you're in California and you're in the highest bracket, you also have state and you're getting close to 50 cents. But somewhere between 30 and 50 cents. If you're in a lower bracket, it's going to be perhaps a little bit lower. But that's critical to understand. So all of the tools and techniques that you find for tax strategy, they're going to do one of three things. They're aimed at either reducing your taxable income, reducing the rate, or deferring the tax to later. So I'll say that again, reducing the taxable income. So if you can lower your income either by exclusions or by deductions or some other techniques, or you can lower the rate, because remember, our income tax system is not a flat rate tax, but rather the more you have, the more you pay. And so it's based on total income, whether you're filing as an individual, as a married couple, as a head of household, etc. There's different thresholds at which the marginal rate will increase, meaning the percentage will increase once you hit certain income amounts. And so some of the strategy might be about how can we ensure that our total taxable income is below the threshold for the next level, right? And sometimes you're doing a combination of both. If you can lower your taxable income, perhaps you will also lower your rate. Now, the other idea is to defer taxes to later. So here, if you think about a retirement account, for example, you could potentially be doing all three of these. If you're funding a retirement account, you're generally reducing your taxable income. If you reduce it enough, you could potentially be in a lower tax bracket. And when you fund a retirement account, a 401k or or an IRA, for example, you're not eliminating the tax, but you're deferring it to later, which means the government's still going to get its cut. It's just allowing you to do that later. And so this is something that I think a lot of people don't understand when they think about retirement planning. I think I'm just saving taxes. The reality is somebody's going to pay this tax. And here, again, there's tons of strategy that is important when you think about this, because if you take distributions, you will pay tax at your bracket. If your children take distributions after your death, they will pay tax at their bracket. And perhaps their bracket might be even higher than your bracket. So now the conventional wisdom here might be inverted on its head, that maybe they're going to actually inherit in their peak years, and they're going to end up paying a tremendous amount of tax, perhaps even more than you would. So that's important when you think about, should I take distributions or not, or should I even fund these accounts or not? Now, again, when you think about distributions, if you have $100,000 in a brokerage account and $100,000 in an IRA, donating, and you say, I want to donate $100,000, there's a big difference between the brokerage account and the IRA. Again, remember, we said the brokerage account is going to get a step up in basis. So if the family were to sell that asset, and there would be no tax. But if they take a distribution from the retirement account, or they liquidate the whole thing, they're going to pay their bracket on tax. And so if you had an option of which item should you donate, it would be the retirement account, because the charity would get 100%. So the charity would get 100%, and there would be no tax to the government. So here, this is where advisors make a huge difference. I get this question all the time, like, I do TurboTax, or I, handle everything myself. That's fine, but you don't know what you don't know. And oftentimes within our community in particular, what we're seeing is that people are grossly overpaying taxes because they're not aware of strategies and tools and techniques that the wealthy are generally taking advantage of. And so for that, you need not just a CPA who's just filling out your taxes, right? Unfortunately, a lot of accountants and CPAs are just, filling out paper and not giving you much more than TurboTax. And that's why so many people say I do my taxes myself, because the accountant is just filling out my taxes. They're not really giving me any strategy. But here, there's a huge amount of strategy that can be considered when thinking about deferrals, when thinking about how to do this. Now, the idea of paying tax later means there's more in your pocket. So it's functioning like an interest-free loan from the government. All right. So now, for the next 15 or 20 minutes, I want to go through some strategies. So that's all way of saying that's background knowledge. Hopefully, it's stuff that you have a good understanding of now when you're thinking about different tools and techniques. And I think the background is critical because, so many people get conned into doing things that actually are problematic. And so it's important to understand what is the tool or technique that someone is trying to sell me actually achieving for me. So if you're a business owner, you have perhaps the most flexibility because there's a lot of things that a business owner can do as compared to, say, a highly compensated W-2 employee. We have tons of physicians, let's say a married couple, both employed in tech or at a hospital as physicians, that are getting hammered in taxes, right? Absolutely hammered in taxes. In California, for example, over 50%. But there's not that much that they can do. We'll come to some amazing strategies that I love. But if you're a business owner, you have a lot more leeway. And I just picked a few that you should be aware of. At least you should think about if you're doing them, or if you're not, maybe you should consider them. So the first technique is an income shifting technique, which is if you have the ability to pay family members at lower brackets, that's one way to lower the amount that's going to the government. And in this, there's a lot of different techniques. There's some advanced techniques. It depends if you can set up a management company potentially. You can hire your children. You can even then hire minor children, and then you can even set up Roth IRAs for them. There's a lot that can be done if you are a business owner and you have children and they're not currently on your payroll. Let's talk. There's a lot that can be done there. So, in fact, it's so powerful of a technique that, as long as they receive less than the standard deduction, they don't even have to file a tax return. And if they have earned income, now they have the ability to fund Roth IRAs every year. The tax-free compounding that can occur there over the course of 30, 40, 50 years is really incredible. And so that's one of the really big wealth, building tools and techniques that a person can have for their children. And I think it's really important also, we have a lot of Muslim clients that are always concerned about, the cost of higher education, and also weary of 529 plans, because 529 plans are generally not Sharia compliant because you're not controlling the investments that are inside of that. But inside of a Roth, you get to control the investments. And so at a minimum, you can take out the principal later without paying tax on it. And so you don't even have to wait till you're 59 for the principal. Of course, the appreciation, you would need to wait until that age. But there's a lot that can be done there. The second are retirement plans. You want to make sure that your retirement strategy is optimized. Now, I have a bit of a contrarian view on this point because I find so many accountants advising clients to overfund their retirement accounts because that's the only technique they're aware of on how to lower your taxes. And so what you find very often is you have clients with massive amounts of debt that are overfunding these, defined benefit plans, and yet they have this huge debt that they could be paying off, for example. And so again, what comes down to, don't make decisions just based on tax or on a tax advisor that is not looking at holistically at your life. The other thing is, statistically speaking, in high net worth individuals, the amount of a person's retirement accounts, remember, if you think about tax-free compounding, if you think about the compounding growth, if you're getting 7% annual return, you're doubling your money every 10 years. So most people are not going to spend down their retirement accounts during retirement. And so this is really critical because essentially you're working for free then. So you're not actually utilizing the money that you're working so hard for, and it's just going to become inheritance. It's just going to become inheritance. In fact, this morning we were reading a hadith after Fajr, and it was interesting because it was exactly on point, which is it said that, the Prophet ﷺ said that what you own, more or less, the hadith said that, what you spend or what you give, that's yours, and what's left belongs to your heirs. And so if you think about it, most people's retirement accounts will not be spent down in retirement. Now, this is not to say don't be strategic, because there's a huge portion of the public that doesn't have any plan for retirement. But then the opposite end of the spectrum is that people's wealth is concentrated heavily in retirement assets and also in, their primary residence. Those are the two, key elements that people have, the two key assets. But at least consider it. The second or the third is bunching expenses. So, you can buy equipment, you can buy vehicles. If that vehicle is over 6,000 pounds, you can actually expense the entire thing in the first year. This is called Section 179 deduction. That's why it's known colloquially as the Hummer tax credit. You see a lot of these big cars, big SUVs and trucks on the road. One of the reasons is because you get to expense the entire thing in your first year, in your in the first year, as the depreciation, supplies, etc. So if you have to do things, for example, if you have subscriptions, in our firm, we use so much technology and we have so many subscriptions that we utilize. I like to pay them at the end of the year. And so that way we're paying for the year in full. Sometimes, they'll give you a little bit of a discount as well if you pay in full for the year. And what that does is that allows you to write it for this year, because it's a fixed cost that you're going to have throughout the year. And so why not just pay it in advance, potentially at a little bit of a discount, and also being able to write it off before the end of the year. Now, a more advanced strategy with consultation with a good CPA is really looking at the entity structure itself. Some people are, just running pass-through entities. Maybe it's time for an S corp, or maybe the income is high enough such that there could be a C corp, and maybe it's a combination. I have some real estate investors that are actually using pass-through entities, as well as management companies that are structured as C corps and then funding retirement accounts inside of those. There's all kinds of different tools and techniques that you should be thinking about when it comes to what is the optimal business structure. And this is something that you should periodically check as your business grows. It might be the case that it was set up appropriately at the time, but now the strategies have changed. So these are a few tools for business owners. Now, I want to pivot to charitable giving, because this is where we focus the most of our time. As a business owner, you basically can expense things. There are more advanced creative things like captive insurance and these kinds of things. We don't do those in our firm. Those are kind of audit risks. We have plenty of clients that do them, but we try to look at, techniques that are well known in the tax code, and most of them have a charitable planning component. And so things like, advanced things like charitable lead trust, charitable remainder trust, starting your own nonprofit, those are the things that we focus our time on. I'm going to start with kind of essential giving strategies and then move to the advanced ones as we proceed over the next few minutes. So what are some basic things that a person could be doing? So instead of donating cash, you donate appreciated assets. So we go back to the Bitcoin example. You bought it for 1,000. It's now worth 100,000. You want to donate $100,000 this year to, a nonprofit. If you donated $100,000 in cash, you will get a $100,000 deduction. But if you donated that $100,000 of Bitcoin, and maybe Bitcoin isn't the best example because a lot of nonprofits are not set up to take the Bitcoin, although if you are a nonprofit administrator on this webinar, I would highly, highly, highly encourage you to work on that, because right now that industry of crypto is just exploding, and people have this type of appreciation where $1,000 has now turned into $100,000. And so it's an easy asset to receive if you set it up properly. So now not only will you take the $100,000 deduction, but you will also eliminate the capital gains. Remember, we said the capital gains would be eliminated on death via the step up in basis. But another way to eliminate the capital gain is to donate to charity. And so you could do that if the charity accepts it, or if you used an intermediary like a donor advised fund. That's something that I think everyone should consider. And if you're a nonprofit administrator, when people are writing you big checks, one technique is to actually contact them and say, look, we don't want your large check. We actually want you to look at your assets. Let's work together and figure out how we can optimize the tax benefits for you. It's a strategic shift that I think donors will be very grateful for, and that allows more money to save and perhaps them to donate even more to you. Now, if you're doing this with your own nonprofit, it's even more powerful, and we'll come to that in a minute. The second is to stack your donation. So understand this point. If you're not itemizing, you're actually not benefiting. And I think most people don't realize this. So the standard deductions are quite high. If you're a married couple, if you're not meeting $27,000-ish in itemized deductions, your donations actually don't save you any money in taxes. And so what a lot of people recommend is that maybe you stack your donations, where you do 3 years worth of donations all at once, and then you utilize that DAP or that foundation to then make the subsequent distributions. The third is if you are taking RMDs, so again, if you're above 70, 72, and you're taking RMDs, consider a qualified charitable distribution where the money goes directly from the retirement account to the charitable beneficiary. And this is a little bit important to understand because there's different rules for 401ks as there is for IRAs. And you have to be strategic about this, and it has to go directly with no intermediary. But understand that doing so can potentially lower your healthcare premium costs and also prevent you from being phased out of certain other deductions that are available and credits as well. So it's something to consider. And you can do up to $105,000, I believe, this year in qualified charitable distributions directly to charity. It would not count as income to you at all. So you don't take the income and then take a deduction that is theoretically offsetting, but not always. You actually don't even count it as income. So that's something that I think a lot of people don't know about and that should be considering if they are receiving qualified distributions and giving to charity, as almost every single one of our clients is doing. Now, in previous webinars, we talked about the idea of charitable lead trusts. Those were incredible tools and techniques that I recommended during COVID when the government's interest rates were really low. We also talked about charitable remainder trusts. And so you can find these in our previous webinars on our YouTube page. I want to talk for the next 5 minutes about creating your own nonprofit. To me, this is the best of everything that you can do. And there's this big myth within the nonprofit sector that, a foundation is something that only the Gates and the Zuckerbergs of the world will have, or that, people like Trump you misuse. But that's not true. There are so many nonprofits in this country, hundreds of thousands of nonprofits that are created every year, or I forget the exact number, but there's so many nonprofits. There's over a million, and most of them are very small. And you have the ability to create your own nonprofit. And to me, this is just something that I think our community is grossly underutilizing. And I like it way more than DAFs. I like it way more than donor advised funds. And particularly for a few reasons. Number one is you still get to control the investments. And this is very powerful because in most donor advised funds, you don't get to control the investments, right? So if you just go and open a DAF at Fidelity or Schwab or Vanguard, etc., you will be able to quickly do it. It's efficient, but you don't have the ability to choose where the money is being invested. Now, you might be able to solve for this if your DAF is large enough. You might have a wealth manager. You might use a Sharia compliant DAF as well. But again, you're still limited with the types of investments you can utilize, namely public equities. But if you have your own nonprofit, you can actually get more creative. Maybe you want to do crypto, right? Most DAFs are not going to allow that. And so now you have the ability to invest in crypto. You can really open up a huge world there. Maybe you're a real estate investor and you want to get into real estate. This is another opportunity potentially to donate. Say you have something that you want to donate to this charity. You can do that in the form of real estate investments as well. There are restrictions, of course. You can't utilize them personally, but there's a lot of opportunity that a foundation has that a nonprofit, that a donor advised fund does not. And so I think being able to control it, when you see like Zuckerberg donating billions of dollars to charity, he's donating it from his for-profit to his nonprofit. And so understand that that is considered a tax deduction, fair market value if it's a public charity, but you're still managing it. You're still fully in control. And so that's something that a lot of our clients really love. And we've done dozens of these this year. I really, really think they are incredible. Tax-free growth. So understand when people are recommending retirement accounts, you have, this idea of tax-free compounding, right? And this is when I told you that every 7 years you can double your money. If you're getting 10% every 7 years, every 10 years, you can double your money. So if you set this up in your 40s, by the time you're 80 years old, you've had multiples over. And all of that happens because a 501c3 does not pay taxes on its income, with limited exceptions. And we could talk more about those on an individual consult. But for the most part, it's tax-free growth. Incredibly, incredibly powerful. Now, if you're thinking about this as a Muslim, this sounds a lot like a waqf, and it really is the closest analog. You could create your own family waqf where you fund and you control and you manage and you give a portion of the profits to charity, and you let the principal keep growing tax-free. And not only is this powerful, but it's intergenerationally powerful because you can get your family on board and you can train them on how to do this work. And they can, manage it after you. And so they can carry out this sadaqa jariyah or this legacy, right, beyond you. And if we go back to remember the retirement accounts, now we're talking about maybe you want to donate a portion of your wealth, up to 20%, 30%, up to a third of your wealth to charity on death. You can do so to your own nonprofit that you create and receive that full tax benefit, and then allow the family to then manage inside of this waqf bucket. But it gets even better. You can actually do work yourself inside of this nonprofit. So when you're creating a nonprofit, it needs to be mission driven. So now you can administer programs, you can provide scholarships, you can do direct distributions to individuals domestically and abroad. So we have so many clients that are like, look, I want to do work in this country. There's so much abject poverty in the world. There's so much, famine. There's so many people that are suffering. And, I'm blessed and I want to donate in a way and with a mechanism that allows me to, directly benefit these people without going through, say, a nonprofit that has a high overhead. Nothing against any public charities that are in existence, but a lot of our clients want to make sure that, say, their zakat money is actually going to the ultimate recipient. Now you get to do so, right? And naturally, you can pay reasonable salaries inside of these nonprofits. So just like a public charity has employees, your nonprofit can also have employees. Those employees can also be family members. And so now, again, we have conflict of interest risks, we have compliance risks, we have to make sure that we're mitigating those risks and that we're, everything is by the book. Just yesterday, I believe, or the day before yesterday, the House passed a bill that allows the Treasury Department to unilaterally declare that a nonprofit is engaged in funding terrorism or material support of terrorism. And, if this goes through, it would allow them, without the standard due process, to basically remove their 501c3 status. This is this is crazy. But compliance is going to be so important now. We got to track every single dollar. And that's where, a good lawyer and a good accountant are going to be keys when you are setting these things up. They're super powerful. I mean, so versatile in what you can do and what you can achieve, but you got to make sure that you're meeting all the compliance obligations. So couple examples. International relief. We have clients that have set up nonprofits doing international work all over the world, wells, health clinics, all kinds of different things. You just providing food in Ramadan, providing, different kinds of, direct relief grants in disaster areas and earthquake relief, all kinds of things that clients are doing. Worship and education. We've helped clients establish masajid, mosques, schools, seminaries, scholarship organizations, like you name it. If you're interested, you can do it. Sports, arts, right? Like whatever you're passionate about. And this is what is so interesting, again, from a classical Islamic waqf concept. If you look at how they were organized, you had, thousands of awqaf inside of a major city where people were funding privately the stuff they cared about. The most incredible examples, like, there were waqfs that would provide wedding dresses to girls who couldn't afford them. And there were waqfs that would provide pots, to servants that broke their pot while trying to cook. And so they could go in and change it. There's so many different things. There were waqfs for animals, right? For cats, you go to some cities, you see so many cats. So there were waqfs that were set up for that. So whatever a person really cares about, they can set up, and then they can fund in their life, either in a good year, say you had, a bonus this year, or you sold a property this year, or you have just really high gains that you're trying to realize a little bit of, this might be the opportunity to fund it. Then you have the ability to keep funding it every year, right? You can put as much as you want or as little as you want in the future. And then, on death, you can take that big gift from the retirement account to your own nonprofit. And so this is just a tool that is incredible. How does it work in terms of timeline? So, it's November 23rd. If you're interested in doing this year, we would need to do so very quickly. We'd want to finish everything by mid-December, because we need to get the state filing. I said 2 weeks here. It takes about a week to do that. Then you have to have governance structures, you have to have a board. You have to make sure that, we have all of that stuff signed. Then you can go open up and fund accounts. That might take a week or so. You want to make sure that we do that. Then we file with the IRS. And that process typically takes between, somewhere between 4 and 6 to 8 months to get the approval. Once we have it, though, it's retroactive to the date of formation. So you can fund this year and still take the tax deduction. We're fortunate at our firm. We have a 100% success rate. Just this year alone, we've set up dozens of these, and we set up a lot of them last year as well. And so I think that this is one of the most powerful tools that a person can focus on. There's a lot of different, techniques. I wanted, each time we do one of these, I want to focus on one. And so today I wanted to focus on the idea of setting up your own nonprofit. And if you're interested, I would like you to reach out so that we can schedule a consult this week and make sure that we can get this process started before the Thanksgiving holiday. Let's take a look here at some of the questions. So in terms of tax-free, as we said, you can utilize your gift tax exemption. So you have basically up until that 13.6 million, which you can gift towards your exemption. You'd have to file a gift tax return. Below that, you have that $18,000 that you can do each year, which you will be able to couple as a married couple. So you could give essentially $36,000 without even reporting. If you wanted to give more, you can certainly do so, but you do have to file a gift tax return. How much does it cost to set up a nonprofit? So the nonprofit fees typically for setup are about $6,000 potentially for a full nonprofit, which means if you're funding it with more than $50,000, roughly around that ballpark. If you're funding it with less than $50,000, there's a streamlined version, and that allows you to, if you pledge to fund with less than $50,000 a year, you can do so, and that will be at about $3,500. And then on an annual basis, you have to file a 990 tax return with the government. And there's some compliance usually within the state. So it might cost a few $1,000s. I'd say if you're doing international work, it's more. If you're paying family members, there's more compliance. So depending upon how complex you want to make it, somewhere between say $2,000 to $6,000 a year if you're doing a full one. And if you're doing a small one, potentially just somewhere between a few $100s to potentially $2,000 a year in compliance. Can you hire yourself in the nonprofit for doing administrative work of distributing funds to charity? Absolutely. So fair market, reasonable salaries are the key. So, because just like a public charity, you're allowed to, hire and be we have many clients that in fact are thinking about nonprofits from the perspective of, they're going to shift into philanthropy. So maybe when they retire, they're going to focus even more on doing direct work, and they're going to take a salary, or they're funding now and they're planning to take a salary in the future. And this is actually one really creative way to supplement what you're putting away into retirement. Now, of course, you'll never be able to take out the money you put into the nonprofit other than as a W-2 salary. So that salary also has to be fair market value and reasonable. And you would comp that against other similar nonprofits that are receiving, nonprofit directors. So you can actually take a salary inside of a nonprofit, absolutely. Again, as long as it's reasonable and necessary for the purposes of the nonprofit. Do CLATs make sense now considering current 25, 75, 20 rates? We're not recommending CLATs anymore this year until the rates drop. I mean, it might make sense if the rates, for the client, but we did a lot of CLATs in 2020, 2021, 2022. But now those deductions are based on the interest rate. The government's interest rate impact the deduction. And so we're not recommending CLATs. I think I would wait on CLATs till next year. I think it's good to have different things in your tool belt. So a CLAT is a split interest trust that allows you to have a portion that is being invested and a portion that's going to charity. Very, very, very powerful tool. But I don't think that I would do a grantor CLAT this year. I think I would rather say, create your foundation now, because the charitable beneficiary of that CLAT can be a public charity if you, so you could couple the two together. So if you don't already have a nonprofit that you are managing, I would say do that one this year, and potentially you could do a CLAT in the future year. Can you contribute to Roth from a nonprofit salary? That's an accounting question. But I believe if it's earned income, then you have the ability to fund a Roth. So we do need to double check that, but it's a Roth requirement is that you have earned income. And so if you are hiring family members potentially that have earned income, then potentially they will be able to fund a Roth as well. Can you contribute to a Roth from a nonprofit you set up yourself? And basically the same question. Yeah. So these are some of these things are done in conjunction between the accountant and the attorney. But I think the answer to both of these last two questions are yes. And again, we want to make sure that there's no conflict when doing a nonprofit. So for a nonprofit, it's important to understand extremely versatile, extremely powerful, also subject to abuse. And so you want to make sure that everything you're talking, that everything is done by the book, especially in light of these recent new laws. So I would say that compliance is everything. Compliance is the key for everything. So let's make sure that we're working together. And if you're interested in this, you can set up a consult with me. Actually, a Monday, Tuesday, and Wednesday we have blocked mostly for nonprofits. So you can reach out to our firm. You can send us an email, and I will put the. You can reach out to our firm, through our website, or directly by calling or reaching out to help@yaseralilaw.com. And you can schedule a consult in the next 3 days if you're interested in setting up a nonprofit. I would like to make sure that we start before Thanksgiving, because it does take a few days for everything to work and everything to get set up. All right, so we are at exactly an hour. Anything else for today? If no other questions, we will stop here. And like I said,